Good evening, sir.
Good evening. Hi. Just
Good, good to hear you back, see you back after illness.
Yeah, I'm seeing a lot of familiar names. Um, that's good.
Sir, today's crash was brutal.
Why do you think so? It was 3%.
No, but wasn't it unexpected? Like because we have already been falling like for the last 6 months, and again this month's closing was another 4% towards the monthly closing.
It's okay. Bear markets happen every 2 years. Can't help it.
Sir, is the tariff war triggering it more? Do you think so?
Who do you think I'm supposed to know? Look, I only read charts. Um, Especially what comes in the frontline news, I don't pay attention to it because see, if tariff wars are the problem, then other markets should also fall, right? But other markets are not falling. We and Thailand, maybe Brazil, these are the only few markets which are falling. Europe is at a lifetime high. Asian markets have not fell that much. US has barely 2-3% away from all-time high. So it's not really bad for the whole world. We have decoupled for this bear market. We are different this time. So, okay, I think we can begin now. Okay, guys, my name is Mithil Pradhan. CMT I did in 2013. Like every technical analyst, I have gone through my period of trial and error with different indicators, different theories, and God knows what. Read many books, traded virtually every single year of my career, last 25 years almost. But I do not trade anymore. I am now a technical investor. And that too only basically charts. Sometimes I will use an RSI, but I don't use RSI in the traditional sense. And then, I invest across the globe. Not that there are too many countries that I can invest into, but I follow a specific strategy. It's an investment strategy which trend tends to play multiple cycles, let's say 2 or 3 bull or bear market cycles at the same time. Some positions are for a single cycle, some positions are for a larger cycle, things like that. And I'm usually always long. As we will speak of different topics, I will share my opinions with you. Remember that no matter what my experience could be, and no matter that I'm teaching you, technical analysis is more of an art rather than a science. So 1+1 is not necessarily true. 2, it can be anything that you want it to be. There are multiple different ways in which people can approach technical analysis or chart reading. But you have to make your own. Even if you copy, it may not work out really. So you have to understand every aspect, every ingredient of technical analysis. I am going to teach you only those chapters which are related to classical technical analysis, like patterns and things like that, because this is what I do day in, day out. I told you I rarely look at indicators. I do not have an algorithm. I do not understand algorithm or mechanical trading because I feel it takes the fun out of trading or investing. I need something which is more subjective in nature, in which I can analyze based on my experience. Okay. All the theories are based, my theories of investing are based on Dow theory, Elliott wave theory, coupled with Fibonacci and proportions, and then finally Edwards and Mithil. Beyond that, I don't think that so I need anything. Now, these books and these theories came out almost 75 years back. But today also, in none of the markets, I have seen that the confluence of these theories don't work. They virtually work across the markets. But again, this is my opinion. Even though I have experience, I am just going to share my opinion. If you want to take it, take it. Otherwise, don't take it. It's absolutely okay. Because everybody has his own idea. Some people may not believe this, or some people may believe in something else, and that is absolutely okay. So we are going to do classical chart patterns today. Any questions? Anybody?
Good evening, sir. Dhananjay here.
Hi, go on, please, Dhananjay.
Good evening, sir. Sir, it's good to see you. I missed your lecture after the level 1. Good to see you in level 2 also. So, sir, first of all, one question from your the discussion you did that, sir, how to invest globally? And another question that last time we read the Elliott wave, but there was no mention of E wave or W wave. But I'm just asking whether this is a part of Elliott wave or not. Like some analysts mentioned that the current E leg is completed. So this context of E leg, sir, that's what just a small question. Under which thing this current E-leg comes, because it was not in the idiot way last time. So that
So
is from me.
first question, I went through interactive brokers. So you can simply search Google. They will allow you to invest in India. They will allow you to invest internationally also. It's international investing is expensive, but see, my strategy was able to solve everything apart from the fact of home country bias. Home country bias is the country that you live in, where you invest, and you always hear good things about your country. And yeah, maybe they may be true, but then they don't allow you to diversify. So you need to diversify at some point of time, because if your home country, because of your home country bias, if something goes wrong in our country, and our markets have gone sideways for 10-15 years, we have histories of Dow and many markets. Japan is sideways now, you can say, from last 45 years. Taiwan was sideways for 30 years. Singapore is sideways since credit crisis. We only hear about markets going up and things like that. But if you look at other markets, you look at Greece, bear market since last 15 years, 17 years maybe. Now maybe it is beginning a bull market. Only a specific few markets in the world which absolutely have done well over the last 20, 30, 40, 50 years, like Argentina or Turkey or US, Mexico, Australia, Canada, and things like that. UK was also sideways for 20 years. France was sideways for 20 years. So if India goes sideways for 20 years, then how do I get my returns? So that's why you go outside. Just a thought. Second thing is E-wave. Okay, so let's think about this, that Elliott wave theory is not the only theory. Waves are not something that Elliott invented. They were already there. So different people read waves differently. Elliott actually died prematurely. He, I think, was not able to complete some of his theories because, see, I don't want to sound pompous, but even I have found certain things which don't fall into the Elliott wave category. Now, once you're an Elliottician, or the other kind of wave theory, which is by Glenn Neely, for an example, these E waves and extension waves, you always find in Glenn Neely, which is even more complicated theory, useful but complicated. So those E waves actually come from there. So wherever you read it, it is possibly by somebody who is following Glenn Neely's work, or there are other like harmonic trading. It's taken a small part from Elliott wave and made a different theory altogether, which is called harmonic patterns or things like that. So there are multiple wave theories. You will have to actually understand all of them to be able to solve the complicated structure of the market. I do not count. I find it of no use to really count. I don't want to predict the exact bear market low. I need to be around it. So I don't need to count it. I don't feel that all predictions of Elliott wave theory work. Sometimes they work, sometimes they don't. So it is a great theory, and once you learn it, you will have a tremendous insight into your analysis. But you'll have to practice. The practice itself takes many years. I learned about the Elliott wave 20 years back. I started applying it maybe 10 years back. 5 years later, I saw something, and it is still developing. So you can understand it. It takes time to work with waves. It's not that easy. And people make all these predictions everywhere. The market is going to bottom out here, going to bottom out there. Sometimes you just don't need it. If you have a general idea that, how much do markets correct? So 25-30% at an index level is decent enough for a particular wave to complete. So we are almost there, maybe 5% more. Then this wave starts getting very overextended. Enough about Elliott wave. I think Elliott wave is a part of level 2, so we'll have enough time to talk about it.
All right, sir. Thank you. Thank you so much.
Generally, the idea of technical analysis is that I don't know. If you ask me what the market is going to do tomorrow, I don't know. Whether the market will be up or down 1 year from now, I don't know. By incorporating I don't know, is there a way you can make a strategy out of it? That's, I think, what most investors do, or even traders do. Chapter is not very difficult. You must have realized that now chapters are written by CMTs themselves. Now, in this particular chapter, it's all about classical chart patterns. Now, because the curriculum has changed, in the old curriculum, these were called bar chart patterns, which was not a correct way of looking at it. A better way to actually name these patterns would be consolidation patterns, because most of them are consolidation patterns. All these patterns were initially found by Edwards and McGee in their book, and they wrote a very fat book displaying thousands or maybe hundreds of different charts and various different patterns. They have identified all these patterns. They have given the name. Otherwise, in Dow theory, he said that markets, when they rise in major waves, they will create a line, right? This line is not important. Okay. Now, he made a couple of mistakes. He called this line to be 5%, but this line is actually nothing. It is a sideways action. This is a line, which he saw it as a line, because if you look at a chart and if you look at a sideways chart, and if you continue to zoom out, and out, eventually this all portion will just look like a line. And that is exactly what he saw, what he found. But this 5% is incorrect. Patterns can actually, I've seen patterns forming at, 100%, or not 100%, but 90% level also. Between the bottom and the top of the pattern, the bottom started at 1 point, for an example, and the chart made a high at 100, and in between that the pattern formed. So you can understand that patterns can be huge. They don't necessarily need to be just 5%. In this chapter, we will calculate price targets. Okay, so we are going to take a few patterns and then we are going to calculate price targets. Now, this is not very difficult because you already have done this before. I'll just put it in a nutshell. Just give me one moment. Okay. So usually this is an uptrend, this is a downtrend. And when it goes like this is a sideways trend. Now, when this is an uptrend, the market is going to move around it. The uptrend is never going to be exactly straight. We can only dream about this, but markets always go up like this. They will also come down like this. But in a sideways market, the markets are going like this, making an irregular sideways correction. Sometimes this high will be higher, this low will be higher, and things like that. Sometimes Even the best of the patterns in the world are not perfect like they show in the illustration. This pattern that they show in the illustration, you will never see in your life, or rarely see in your life. They're all jagged. You have to figure out, you have to play with them, you have to draw multiple lines and then try to contain them. But all of them are basically nothing but imagine a line which is going sideways. Okay, now this sideways line, if it goes like this, and it has perfect two or more tops or perfect two or more bottoms, tops at the same place, bottoms at the same place, then it will be a rectangle. Okay, so rectangle consists of two horizontal lines above and below. Again, a sideways pattern, but the overall pattern is triangular, which means now we are no more using horizontal lines. We are now using slanting lines, one slanting down, one slanting up. Then we have a symmetrical triangle. We can have the same symmetrical triangle, but then only one line is slanting, one line is horizontal. So slanting plus horizontal makes the ascending or the descending variety. This is the descending. If a very small triangle forms in a very sharp rally, then this will be called a pennant. Okay, and then these are the ones. Then you have the slanting variety, which actually there is only one, which is like this. Okay, now try to think about it. In the rectangle, no higher high. The highs are getting locked and no lower low. Lows are also getting locked. They are all occurring in the same location, at the same line. In the triangle also, lower highs and higher lows. Okay, again, there is a boundary. No new high is being allowed. This is not allowed. And no new low is allowed. So they are all contracting. Even here, again, contracting. Okay, flag is the only sideways pattern which goes a little slanting. Okay, it does make new low, maybe a couple, and of course it does not make a new highs, but at least new lows it is making, and yet it remains absolutely bullish. Why? Because if the market has to kind of correct, it usually corrects at a very sharp angle. Somebody just said that today's fall is brutal, but that is what bear markets are supposed to do. They are going to surprise you on the downside by falling faster. But when it does not fall faster, this was the line that it was supposed to take, but now it is actually going this side. Okay, so the angle is more flatter. That will be basically a flag. Now, theoretically, now this is my flag. Ideally, this should be called a flag, but there are many people who will call different things different flags. The jury is out. I don't know who is right, but typically, a typical flag should ideally look like this. Okay, now there is one more pattern. These are all sharp lines, that horizontal and slanting lines that we have seen. In the flag, we have a line like this, a kind of a parallel channel types. But there are also other geometric patterns which use this half circle. Patterns that fall like this. This is the rounding bottom. All of you guys have studied this. I'm not going to go too much into the depth. You recognize this. The idea is to recognize these patterns. And then sometimes with the rounding pattern, you will have a nice small pattern also. And then it will become a cup and handle. Okay, it doesn't always have to be rounding. People try to train your eyes into the rounding aspect of it, but it can be something like this also, a little sharper, maybe another handle also, and then it will be a breakout. I've seen a lot of patterns like this. They can be a little sharp. And in this rounding nature, there is one more pattern that falls, which is the head and shoulders. You can see that there is a round, then this moves. The rounding also occurs at the top in terms of a head and shoulders. This is the head and shoulders that occurs at the top. Again, there is a rounding. Don't look at absolutely rounded edges. You're not going to get perfection in the market ever. You're only going to get patterns. Also, one simple advice, so many people need to be not told, but actually hammered about this fact. Just because there is a head and shoulders on a chart pattern does not mean that the chart is bearish. Things that can happen. Of course, the head and shoulders may break down and it may go down a little bit. And then if the original trend was positive, it will go and behave as if nothing happened. Or it can give a breakdown, give a fake breakdown, and then even strongly go up. And the last one is it will give a breakdown. But this reversal pattern reverses certain trend. It may not reverse all the trend. So in a typical bull market stock, even if there is a head and shoulders, I'm not going to pay attention to it. Sometimes the head and shoulders just doesn't break. What will happen is this will make a double bottom. You see a head and shoulders just about to break out, and then the market will continue as if no, there was no head and shoulders. You saw head and shoulders, or I saw head and shoulders, but there was no head and shoulders for the market. It was just a typical pattern. So these are the major patterns that we have to study. Two more important points I'll just quickly cover, so we don't have to go through boring too much talk. This is your sideways pattern. You will take the depth of this pattern, which is the highest point and the lowest point, and it differs for different patterns. For an example, for the triangle, it is between this and this, right? Mostly for all the patterns, even if you're looking at a head and shoulders. So this is your head and shoulders. This is your highest because this is where the shoulders meet and the base of the head. This will be your measurement. For all of these sideways patterns, what you need to remember is an upward breakout is different from a downside breakout when it comes to setting price targets. When you set up, if there is an upward breakout and you want to set up the upward price target, you will take the absolute difference between the high and the low, which means if the high was at 10 and the low was at 2, then 10 minus 2 is 8, and you will add 8 to this point, which will give you a price target of 18. But when any pattern breaks out on the downside, then you will take the depth as a percentage between the high and the low, and then add that percent from here to get your downside target. So write it down somewhere, maybe write it 10 times, and you will understand it, that you have to take a percentage difference between the high and low only when it comes to downside breakout. The upside break, you continue to do everything that you're doing. Okay. Now, to use a percentage difference, you cannot use a linear chart because linear chart will not correctly show you the percentage difference. You will have to use a semi-log chart. Semi-log, actually, you can use it all the time. All my charts are semi-log charts because I want to see the percentage movement. Now, I'm a Fibonacci guy. So in Fibonacci, I have eventually learned that though in the short term, it does not really matter. You can take the linear chart and do very, very well. But when you come to long-term charts, you want to use a semi-log chart. So how do we refresh this? Now, can you see anything on the left of the chart? You see this? Zoom out again. A monthly chart. Problem with investing is every single time you do not actually find the complete data. That becomes a problem. See, in the semi-log chart, it looks as if NTPC had a massive bull market, especially this portion, that it rose a lot. But then it is because on an absolute basis, it has traveled a lot of points. But if you actually look at it, it is big, but it is not that big in percentage terms. Such kind of rallies have also happened before. Some better chart is required to make this point. You look left here, you can barely see what Reliance was doing here in the 90s. Because what is happening, as if you feel that the recent few years of movement of Reliance has been the most important, whereas that's not really true. You need to be able to see the clear pattern. The clear pattern is only visible on the semi-log chart because it takes percentages into equation, and percentages are very important because markets actually move on percentages. They don't move point to point. Nobody cares whether Nifty dropped 100 points or 200 points. How many percentage points did it drop? Usually your target making will actually improve if you use percentage changes, both for up and down. But remember, from the exam perspective, for up, you need to take the linear or the absolute difference. And for the downside breakout, you need to take a percentage difference. There are a few charts we'll go through and to make this. I've used a few charts to make that point. Price targets are guidelines and not as rules. Absolutely, you will realize that price targets may not be even necessary that much. Sometimes, like I always feel that the exit part of the trade or the investment is always the most toughest part, because there is nothing. If the stock has done really well, then it is at a lifetime high. For an example, when you're looking at it, apart from the indicator overbought, you will actually not find too many reasons to actually sell the market. And even indicator overbought is not a great signal any which ways. Markets can stay overbought for a very long period of time. They may always stay overbought if they want. But when it comes to exit, it is not possible to figure out when exactly to exit. So even when it comes to targets are just guesstimates. They're guess targets. There is, it's like a common minimum program. When a rectangle breaks out, it will travel to the distance equal to the width of the rectangle. Okay, fair enough. But there are many rectangles which break out and they go up way far away from those breakout points. We also know that sideways trends, and it is believed, and it is most people believe that when a market breaks out of a sideways trend, assuming this sideways trend is for a longer duration, then these trends tend to remain in motion for a long period of time. I work on monthly charts, and I can tell you that if there is a breakout on a monthly pattern of, let's say, 15 or 20 years, that bull market that will begin from the breakout will last decade, or maybe 1.5 decade, or maybe even 2 decades. That much is the time that stocks can continue to go up. The problem is that when you talk about long-term charts, their corrections are very, very sharp. So if I buy a position which has even gone up 10x, for an example, I might have to see that 10x becomes 5x only. Half of the gain is gone, and then it will go and start the next leg of its rally. So multiple times it is going to give 20, 30, 40, 50% multiple corrections and then reach a long-term target. And that is how many people actually, say that this is the way to make a, wealth in the stock market, by being into a breakout stock, either fundamentally or technically, and remaining in it for a long period of time. Not too long also, because too long reduces the CAGR. Maybe about 7 to 10 years is preferred. Okay, here the author talks about semi-log chart. Breakdowns and breakouts will take place much earlier on the semi-log chart than on a linear scale. I don't know. Maybe when you're talking about slanting lines, then it may be absolutely true. But I'm not sure whether this really happens. Semi-log scale allows for a better long-term analysis of trends. Absolutely. If you're using a absolute linear chart for long-term analysis, it is going to be of no help really. You're not going to be able to see the patterns as it is. Head and shoulder breakdown in Nifty currently. Yeah, that happened about a while back. You're right about it. I think it broke about a couple of months back. Okay. Now here there is a statement. All the statements I have highlighted. You can also highlight it. Some kind of a question can come out of it. Ideally, they will ask you to calculate targets, or they will ask you where will you put stop loss, and there are a few more points. So usually this is about target calculation. They may show you a pattern like this. They may show you, how much the pattern is. Approximately, they may give you a high and a low for an example, and they will ask you to find a target for this particular move, or they may ask you on which candlestick that you may enter and things like that. Apart from, it's not very difficult really. Advances from flags or pennants in uptrends generally go farther away. Now, flags and pennants are the only exceptions to what I have told you so far. Okay, flags and pennants are actually different kind of patterns. They occur in very strong trends as a small stop for the time being. Now, the price was very strong. Instead of correcting, the price has decided to go sideways and waste a lot of time here. Okay, this shows the underlying strength of the move. It is not correcting. Profit booking is not happening. Buying was good here, but buying is a little weak here. But selling is also weak. That is the reason the market has gone sideways and in such a tight range. Flags are very tight and not, you will see that the price is going up and down every 2 days. But really, the price is not really going very far away from the all-time high or whatever the peak is. Okay, it is definitely not correcting. So this is a weak correction. I will tell you one more thing. This book doesn't talk about it. But suppose if you're using an indicator like a stochastics, okay, usually what will happen is the indicator and the price will peak out together. But price will go sideways, whereas the indicator will travel down. So when the price comes here, doing nothing but sideways, the indicator has already been oversold at a much higher price level. And the indicator has now started giving buy signals, and that is usually when the breakouts will happen. The thing that you need to know is that if this is your rally and this is your flag or the pennant, then you will have to count from here, from the low to the high, and add it to the breakout point to get your target. Now, the only mistake that can happen, you can always calculate this and add it to this, to get this. This is good. But you have to also find the starting point of this move. Now, some examples are given to you, and we'll come to that. Ideally, I would take the major low as the starting point if this has happened, but you will see that your author has thought a little differently. We'll come to that. Flags and pennants, uptrends will generally go very far away in terms of points or dollars than the preceding move. Which preceding move? This preceding move. This is your preceding move, which you're adding here. So they're saying it will go even farther away than the target that you have analyzed. Declines may not carry quite so far. In point terms, I believe, but in percentage terms, more or less it will. But remember this statement. They may give you actually a flag which is breaking down. Formula is best applied on semi-log chart by measuring actual chart distance rather than by counting points. Thus, a logical way to measure price objectives to the downside is to use percentage changes in all the cases of Downward breakouts, you will only use percentage changes and not points or dollars. Upward, you will only use points or dollars. This will, of course, give you conservative price targets. With upward breaks also, when you take only point or dollar changes, it will give you a conservative price target. There was no need to add conservative or this thing, but yeah, I understand that with the percentage method, in the upward breakout, you will get a larger target. But by using a dollar change, you're actually getting a little lower target. For a short-term pattern, it will not really make a lot of difference. Okay. Now this is your head and shoulders. There are actually two head and shoulders here. The first one is a small head and shoulders. It has a neckline here. The downward breakout is here. You will take the neckline and add it to the breakout point. But the breakout is downward. So then you will take a percentage difference, which is coming as 22%. To this neckline, you will deduct 22% to get this target, which gets met here. Easy peasy, not very difficult. Apart from the fact that you have to use percentages, nothing much is difficult. There is another larger head and shoulders. This is your breakdown. This is your neckline. This is the head. You will take this difference in percentage terms and deduct it from here to get your downside. They will ask you to calculate. They'll give you an MCQ with various different options, and they will ask you to calculate the real option. One of the wrong options will be the absolute measurement. One of the right options will definitely be the percentage method. It's similar, the same chart, same head and shoulders. It was a 46% decline. Okay, remember this formula. They have taken the neckline, deducted from the head, divided by the head to get a 46%. Usually, as far as the chart is concerned, we usually have a measure tool on investing.com, or like I use a Metastock, so I have a measurement tool. I don't like the measuring capabilities of web because always there is some mistake, I believe, in actually reaching when you're calculating price objectives. So I like a Metastock or an Amy broker. If you want to be a serious investor, even TradingView, web-based for this thing, your calculations might be different. I mean, I use proportions. I really cannot do with TradingView. If Metastock and Amy broker close down, I'm in for a big trouble. Price target calculation for head and shoulders bottom is the same as the head and shoulders top. What is a head and shoulders bottom? This is the inverse is the head and shoulders bottom. Given that this is a bullish reversal pattern or an upward breakout, you will have to take points or dollars, not percentage changes. Okay, so this point has been driven home. You can see that from the head to the neckline, it was 5 points. They have just simply added 5 points to get a target. Measuring rule for the symmetrical triangle is slightly different than what the community of classical chartists have been applying. Okay, what they are saying is this, that if this is your triangle, then this top is actually the target. So this pattern breaks out here and then it reaches the target. The other perceived or believed idea is that we take the depth of the pattern and add this depth of the pattern to get a target. But Edwards and McGee apparently have recommended a conservative way of achieving targets. Can you see it is achieving the targets of the peak right here? The breakout is here and the target is here. Doesn't make sense. It is what it is. The approach taken by new generation of classical chartists take the depth of the pattern in absolute price terms for upward breakouts and in percentage terms for downside breakouts and add to the breakout level above the upper boundary of the symmetrical triangle. Apparently, I was wrong. Take this depth and add it here. Is that right? Is that what they are saying?
No, sir, maybe from where it is converging, basically.
Okay, I haven't given an example.
In the one above.
Yeah, this one. Yeah. Okay, 1 second. Add it to the breakout level. Breakout level was just clarify this, guys. Otherwise, we could end up making a mistake.
The first example is showing that above the green line there's a buy stop, and after that you can add the width of the triangle target. And the second example is showing after the trendline breakout you can add targets of the triangle width.
You mean here, right?
Yeah, it's first approach. After the break of this green line you can add targets of the width of the symmetrical triangle.
From here.
Yeah, above that. Yeah.
Okay.
And in the second example, they are showing that after the trendline breakout, you can add the targets. In second example.
Correct.
Yeah.
Yes.
Correct. These are the two possibilities. You take the width and add it here, or you take the width and add it here. Thankfully, they have given options, so it's not as if they can ask you a question which one is preferable. Ascending triangles and rectangles are very, very easy. You just take the depth and add it to the breakout point. But symmetrical triangle is always usually a little tricky, according to me. So this is clear. This we don't need to revisit. Okay, again, this is a descending triangle. Very nice textbook descending triangle. Again, they have taken percentages. You need to take percentage whenever you're dealing with downside breakouts. I'm not going to get into this. This is important that the larger and clearer the pattern, whichever kind of pattern, the more extensive the movement of prices we may expect to follow its completion. And trust me, guys, when I actually noticed this phenomena that happens, because see, I was looking at patterns on daily charts. Now, many patterns used to fail, and some used to go 1x of the width or 2x of the width. That was not enough for me. I needed more. So when I started looking at ultra long-term patterns and all, the breakouts that happen from ultra long-term patterns tend to run for years, even a decade and things like that. So this statement, keep it in your memory. It may be helpful someday. Hence, accept price targets as guidelines rather than rules. Actually, there is a problem with price targets, if you ask me. Suppose this is your target, no matter what kind of methodology you're using. There are multiple ways in which, price will approach this. The best thing that you expect is that it will touch and then it will go down, fulfilling your target. But this actually rarely happens. Many times it will go all the way and come down. Now you're worried that, oh, my target is left out, and you sell out, and then the price goes higher. Third thing is that it may go high, not touch the target, and start reversing altogether. The fourth, even more painful situation is that when it comes to the target, clears it and goes and goes and goes and goes. So there are actually targets create a different kind of a problem in real life trading. Sometimes I feel it is better not to have one, assuming that these patterns will create dynamic big trends. If that thing is proved or accepted, then maybe a trailing stop loss, though even a trailing stop loss comes with a lot of problems of its own. So some different kind of a way has to be generated, like maybe winding the position down slowly at different levels and things like that. I don't have the answer. I use slowly winding down because nobody knows the target. Target is always something that is elusive. Okay. Now this is showing you a rectangle. This is the point that I was trying to make. If you take a 15% target from this breakout zone, you will get out here, whereas price goes 2x of this width. This is 1x, this is 2x, 3x, and it is still going down. So this actually beats the age-old theory that you have to let your profits run. If you take your not every breakdown is going to go to 2x, 3x, or even 4x. Some may not even go to 1x. But the ones which go will create massive profits. They alone will stand out in your entire portfolio of trades, and they would be the ones who bought the highest profits. I mean, this is a theory that I believe to be true. You have to let your profits run.
So, can you just pull up to the richest patch that we can take a screenshot
Screenshot of what?
of the upper previous page of the this camera diagram.
Of this, what I've marked?
No, previous one.
Tell me where to stop.
This one.
This one?
Just below,
Okay, any which ways, this video will be there. You just have to go fast forward to the period that you want. You can take the time now. We have just about 50 minutes from the class. You can just take a
Okay.
screenshot. Previous, if you want, I'll show you this one, previous one. This one. This could be the only one which is screenshot worthy, I guess. Can I move on, please?
Yes.
Again, 2x, 3x, 4x, 5x, 6x. It's a beautiful rectangle. See, when you contract price for months and weeks and years, think about it that somebody has been stuffed into a small prison, this much kind of a room the whole life. When he breaks out, he's going to break out roaring. So that's usually what happens when such contracted patterns break out. This is the fundamental on which the theory of squeeze, Bollinger Band squeeze, is based on. In squeeze, what happens is the Bollinger Bands become so tight with each other, price has no room to move. The volatility is at its lowest. So you have, pinned down the price into a very small range. And when they break out with massive force. So breakouts, breakout trading basically follows the same concept. Flags and pennants are characteristics where they occur in basically very, very fast moves, because the price is so much in a hurry to go up, but only for a very short period of time. It is not finding enough buyers. Okay, so what does it do? It goes sideways, making a flag-like pattern. The flag has many variations. Or it will make a pennant. Pennant also has variations. They might see, they don't talk about it, but you may also, all these patterns that you have seen so far, they all have their micro versions also. For an example, price is running strong, and then like this, it will make a small rectangle and go away. Okay, or it will make a small triangle and go away. And you'll find variations of all patterns. Flags are most commons, followed by maybe pennants. Measure the same distance from the point where price breaks out of the flag. Okay, so here is my dilemma. Okay, now ideally you would say that the move began from here, it reached here, this is where it created a nice flag, bullish flag, and from here it gave a breakout and started moving up. But the author has looked at this gap, which he's calling as a breakaway gap, as the beginning of the pattern. So when we look at all this, the reason we look at various examples given by the author is to figure out how the author is thinking. If he wouldn't have given this chart, I would have actually started from the bottom. But he has said, according to him, that the breakaway gap is the starting point of this trend. And then naturally, the breakaway gap will score higher than this low in terms of price movement. Okay, so no matter where, suppose if you don't see a breakaway gap, then that is not a problem. Simply take it from the bottom. But if you do see a breakaway gap, what is a breakaway gap? A breakaway gap breaks away from a congestion like this. You might say that, hey, but there is not a clear gap. There was a clear gap. The market opened here. It just made this V reversal intraday and then never looked back. There was a gap. It just got partially closed. So if you see a breakaway gap, then count it from the breakaway gap or from the last consolidation. Here also, there is a confusion that is built. He's taken the previous high and he's taken it from here till here. And then you don't add it to the bottom of the bull flag. You add it to the breakout point or the resistance level to get your target. Let's see if we have one more example. No, we don't. Any confusion here? Okay, again, whenever you look at prices breaking out from a downtrend, you're going to look at a percentage change. Okay, that much we know. Setup signal and risk to reward ratio. Now, naturally, whenever you talk about risk reward ratio, the entry price also comes into existence, because you need to fine tune your entry. Sometimes the market runs away so far away from a breakout point that your risk reward ratios get really bad. And then even though the pattern was an absolutely brilliant pattern, you really cannot chase it, because the price is far away from where you would like to have it. Price, first of all, needs to close above or below the pattern boundary by a margin to confirm the breakout. What kind of margins do we know? We know two kind of margins. We know the 3% rule, that this is your resistance, add 3%. This is your resistance, you add 3% to it to get another layer above your price, above which the price has to go. At the same point of time, if this is your resistance, then price at least has to close one candlestick. Price needs to close above the breakout point. You can see that 3% daily close here, above or below the pattern boundary to confirm a breakout or a breakdown. Naturally, the 3% is not the best idea because it depends for stocks. And this 3% is a daily close. I mean, it's a level for if you're looking at daily breakouts. That too actually may not be good enough from a practical perspective because every stock is different. Every stock has a different character to it. It is going to follow all the rules of Dow theory and Lefebvre theory and things like that. But still, the personality of every stock is different. For some stocks, 3% is nothing. I'll tell you about my experience. See, in India, we have circuit filters, we have ASM, GSM, a lot of different layers of security has been provided by the exchanges and the regulators. But in US, yes, the regulator is very strong, but there are no circuit limits. In which case, stocks can actually jump around like drunken monkeys. Okay, I have a stock which I'm following. And I was myself surprised because one day it was down 12%. The very next day, it was up 28%. The very next day, it was again down 50%. Okay, this is crazy volatility. Now, for such a stock, a 3% trigger is nothing. Okay, so you want to wait, you want to use some other methodology. Or you want to maybe increase it to 5% if you may. But the author does not. The author sticks at 3%. Even if you're trading currencies, for an example, 3% is a huge move in currencies, especially if you're looking at a daily chart. Maybe for a monthly or for a weekly, it might still make some sense. But for daily chart, 3% is huge. If you have to wait 3% for confirmation, you might have actually left the target behind. The targets are also smaller in currencies. That is where you will find a problem. There is a solution given, which is the average true range. The amount of movement of the past pattern boundary can offer an objective method of decision making that will adjust for each instrument's own volatility. Now, what the ATR is doing is ATR is looking back at the range, let's say the last 10 days range, and it is then averaging it. You know about ATR, so I don't have to go on and on about it. But the ATR is adjusting every single stock to its own volatility, okay, and then giving you a filter. So that makes a lot of difference, in terms of containing volatility into your calculation. Now, where to keep stop loss? Ideal place to place a protective stop loss is below the pattern's boundary. This is number one. And the number two is below the low of the previous day's candle as a stop loss. Now, try to understand that the previous day's candle would ideally mean the breakout candle. Because now you're acting today. Yesterday, the breakout happened. So previous day's candle is the breakout candle. So this is your breakout candle. The candle that comes before that, as long as it is inside the boundary of the resistance, you will take this as a stop loss. This makes sense? Everybody clear? You don't want to put a stop loss, and rightly so. The author is absolutely right here. Spot on. See, when a military force, for an example, is fighting at a border, this is the border, it is trying to get inside. It is not being able to because the defense is stronger here. But once the defense breaks down and we march ahead, then you will continue to move ahead. Okay. Ideally, you will not come back inside. So the rule with breakouts is that any breakout after it moves higher above a particular resistance, you don't really want it to come inside the pattern. It may come a little inside and you will expect it to bounce back very quickly. It should not waste a lot of time. Okay. So in my sense, what I personally like is, let's say if this is the breakout candlestick, then this breakout candlestick is the most important to me. Now, the low of this breakout candlestick ideally should not break. And they have done an even smarter thing actually. They have gone to one candlestick before the breakout, and instead of using the breakout candle, they are using the previous day's candle, which is actually a very, very good idea. Remember, this breakout has to meet either the 3% rule or either it has to meet the ATR rule. It has to pierce. After piercing this resistance, it has other confirmation resistances to pierce. And this is the most difficult part of breakout trading. Anybody could have done breakout trading if they knew exactly when the breakout is successful, when it is not. Because if you do make a mistake of calling the breakout early, then and if the price pattern gets inside, then remember that what has happened. This resistance regenerates itself. It calls this a futile attempt or a failed attempt at taking power, but there was no power, there was no follow-on buying. When suddenly everybody realizes this, the shorts who got triggered because of this and new longs which got created, they all run for cover. So long sell, shorts reposition themselves. Suddenly, there is a barrage of orders here because now what the market showed, the market has not done it. The market has flipped it. Market has trapped everyone on both the sides. Usually, there is a strong decline or strong reversals if breakouts fail. So you can trade breakouts also. You can trade fake outs also. It depends upon how good you are in figuring out what is happening here at the breakout point. If you can figure that out, then you can trade breakouts both the ways. Any which ways, all breakouts, about 50 to 60% of the breakouts actually fail. It's one of the best ways to trade or invest as the case may be, but it is not easy. And the only difficult part is where the breakout happens. That is the most difficult part. Okay. They consistently, the authors and in many different charts also have seen this, that they use a combination of the 200-day moving average and they find patterns which kind of coincide with a particular pattern resistance like a head and shoulders neckline and the 200-day moving average to tell you that the market is breaking both of them and hence it is important. Maybe it is. So we can improve our risk reward ratio by applying a tighter stop loss, which is just right below actually the breakout candle. One second, let me just check and they put it on the breakout candle. Here they have taken 1 day before the breakout, and here they have taken right below the breakout candlestick. Okay. Okay, so they have adjusted the protective stop loss order to the close of the previous day. With this slight adjustment, we are able to improve the risk reward ratio. Yes, but the trade also becomes a little more sensitive. You want to give a little room to your stock because especially if you're using a mid cap or a small cap stock or not a big company, then it is possible that certain orders or a group of orders can trigger your stop loss and the market can then go high. It's possible. Average true range is a volatility indicator showing average price variation of assets within a given look back period. Okay, this might be important, but something that you would already know, the calculation of ATR. ATR does not tell you the direction of the breakout. It can be added to the closing price and the trader can buy whenever the next day's price trades above that value. A daily move that exceeds an ATR value is considered significant and a breakout trading signal or confirmation. So here you can see that this is your neckline and this is your ATR value. You want the market to go above this to trigger. In a general sense, it seems though it may not always be true, that the ATR might actually give an early entry than the 3% rule. Again, it may not be true for everything, for most of it. Okay, so classical chart patterns are consolidation periods in steady uptrends and downtrends. Okay, basically, I like to see it this way, that the market has continuous 2 cycles. The cycles are up, down, up, down, up, down, and trend range, trend range, trend range, trend range. These 2 cycles continue forever and ever and ever. Generally, what the author is talking about is, if you see a large uptrend, it is quite possible that parts of this uptrend will be sideways kind of trends. Whatever we can't recognize every single sideways pattern. It is not possible. Some are variations. You might see patterns like cup and handle with 2 handles and then a breakout. Or you might see slight variations, you might see a cup and handle which is moving a little higher, up slanting cup and handle, for an example, and then a breakout happens. There are multiple different variations that you will see. So if identified early, range bound price action can be useful in applying mean reversion strategies. Okay, so mean reversion, how does it come into existence? There is a trend. Now, at some point of time, you may feel, or it is likely, that the market will go into a range. So you use mean reversion in between this. Okay, so the mean is the moving average. You can always play mean reversion, bounces to mean reversion and things like that. Though I will not really advise playing mean reversion. There is no fun in trading mean reversion, and there is very high risk. This involves selling at resistance and buying at support until a confirmed breakout takes place. So if a pattern develops, for an example, you have to wait for this much price action, and then only you can say that, oh, you know what, maybe a pattern is developing. Now, you don't know for how long this pattern is going to last. You don't know whether the pattern is going to last, whether it is a pattern also in the first place. So I personally don't like playing these ping pongs, selling the peaks and buying the bottoms during a sideways price action. I mean, I have never seen a professional trader doing this. The fun is in trading the expansion out of a trading range, because that contains energy. A sideways action is a period of no energy, low volumes, nothing really going on. Buyers are balanced with the sellers. But when there is a strong trend, there is an imbalance, like what you see today in the Indian markets. There is an imbalance. Why? Because sellers are much stronger than the buyers. The same thing again and again. So I'm not going to go into that. So the idea is that, can point A act as a resistance and offer an area to initiate the mean reversion strategy? Maybe, maybe not. There is an uptrend going on. The most fundamental idea about technical analysis is to follow the trend. So if the trend is this, you don't want to sell this. But this chart is incomplete because we can't see what happened before on the left. But suppose on the left, if this was coming from a major bear market, then selling this might make sense. Amount of chart that is given to us, at least I cannot draw comfort from it. I cannot take any position unless knowing what is the major trend. Of course, they will always handpick their best ideas. So yeah, this is a sideways range developing. You have sold the high. You may also want to buy the bottom based on a candlestick signal or something like that. Or there are other ways of looking at it. Even though I am not in big favor of doing or selling this, I am in a big favor of buying this, especially if the trend is up or the longer trends are also up. Because double bottoms are very important in during uptrends. Okay, so this, don't have to always sell the ping and buy the pong. You may choose which part of the sideways ping pong you want to play. You will use candlesticks and things like that, to pick this bottom. It's risky, but it is worth it. And then eventually the price goes higher. It's a bull market. So yeah, guys, that's about it. I feel the only keywords from this particular chapter are targets, the absolute targets and the percentage targets. Next important thing is the 3% entry rule. Sorry, this is also important, remember. If they ask you about symmetrical triangle, don't forget this. And the next thing is flags, measurement of targets of the flags. And then the 3% rule and then the ATR rule. Usually they will ask you to calculate targets or they will ask you to calculate risk reward ratios, either ways. So whatever examples they have given, read through it once. Otherwise, this chapter is not going to be that difficult. It's comparatively much easier. Questions?
Can we again expect some questions on the volume along with the chart pattern?
Yeah, it is possible. You should know if they ask you. So there is a separate volume chapter,
Okay.
which will ideally answer most of the questions. But with respect to breakouts, what you need to remember is that during a sideways move, volume is going to be low. Volume is going to be falling as market goes sideways. Remember, sideways, there is no energy in the market. If there is no energy, energy comes from volume. There is no volume. But once the breakout starts happening, volume starts to expand. It is not important that breakout has to happen on the exact same day of the breakout, but volume should ideally expand as the market starts to trend. On the downside, volume is not important. Stocks can fall on their own weight. So downside breakdown without a volume signal is also good enough. But an upside breakout, you may want to look at an uptick in volume. That's all. I mean, there's nothing else about volume pertaining to this chapter, at least. Usually, I think most of you will find this very, very easy. You might have to just read it once, solve a few examples of calculating targets and calculating risk rewards, and you're going to be done. So if there are no questions, then I'll see you tomorrow, 10 o'clock in the morning. We'll do candlesticks. Yeah, I use all the patterns. In long term.